What is an expansionary policy? Expansionary policy is a macroeconomic tool employed to stimulate an economy experiencing declining growth or recession. Both the central bank and the government may implement monetary or fiscal policy measures to improve these situations, thereby promoting economic activity and growth. Expansionary monetary policy focuses on increasing the money supply, while expansionary fiscal policy involves increased government investment in the economy. Expansionary policy measures aim to combat low production and high unemployment levels. By injecting money into the economy, these measures stimulate economic activities. For instance, lowering borrowing costs facilitates credit creation, encouraging public spending. Additionally, tax cuts can enhance consumers' purchasing power and boost aggregate demand. When an economy slows down, production decreases, resulting in low output and high unemployment. This situation leads to reduced government revenues due to lower tax contributions and increased costs from unemployment benefits. The resulting decline in demand for fixed assets and consumption further exacerbates the economic slowdown. To prevent further decline, it is crucial to introduce expansionary policies to revive economic activity. Aggregate demand, comprising consumption expenditure, private investment, government spending, and net exports, requires boosting during low economic growth. Monetary policy comprises measures that control the money supply in the economy. Expansionary monetary policy increases money supply to incite spending on various goods and services. One effective measure is reducing interest rates, making borrowing cheaper and encouraging both capital investment and consumption. Lowering reserve requirements for commercial banks allows them to lend more of their deposits, creating credit. Open market operations, where the central bank purchases government securities, inject funds into the economy and reduce bond interest rates, further decreasing borrowing costs. These measures boost aggregate demand, increasing output and employment levels. Fiscal policy utilizes government spending and tax policy to influence economic trajectory. Expansionary fiscal policy occurs when the government reduces tax rates or increases spending, shifting the aggregate demand curve rightward. Lowering income tax raises consumers' disposable income, enhancing purchasing power and consumption expenditure. Corporate tax cuts provide firms with more capital for investments and job creation. Additionally, increased government spending can occur at the central or state level, enhancing production capacity through projects such as infrastructure development. Subsidies and transfer payments can also improve purchasing power, further stimulating economic activity. The impact of expansionary policy manifests in increased aggregate demand, shifting the economy's equilibrium output. For instance, during a pandemic, government stimulus packages can raise aggregate demand, moving the economy from low output to higher levels. Increased spending on infrastructure generates income and employment, further enhancing aggregate demand and driving the economy toward full employment output. However, expansionary policies also carry risks. Excessive borrowing by consumers and companies can become unsustainable in the long run. Moreover, rising general price levels may occur if expansionary measures are not followed by timely tightening. If prices outpace wages and savings decline, it can lead to currency depreciation and uncontrolled inflation, potentially spiraling into hyperinflation.